Good evening. So today we are talking about money. Today we are not talking about motivation. Today we are not talking about relationships or anything motivational. Today we are speaking in the language of money. So as we are talking of money, today I'm just going to talk about investing. Investing is a general term, or we have heard of investing, and many of us think that investing you need a lot of money. Yet there are so many avenues where you can try to invest, and then that money, after some time, it can compound and then you get something to do. So investing, first of all, you need to first focus on learning on how to invest, because investing generally it will tackle different different let me say schemes, whereby in order to invest you have to first learn how to budget. You're going to learn how to track your investments. You're going to learn how to manage your assets, and then you're going to learn how to handle your expenses, so that you can stay informed about your latest financial decisions. Because most of us, we are spending every day, every single day. You have those needs, you have those wants, you have that latest show, you have that Netflix subscription which you're always subscribing to. Because now, like us who are into fitness and athletics, you have those subscription apps whereby, like Strava, they want you to subscribe to get more features. So in the long run, that is also an expense. So generally, you're advised to save at least you start saving in your early ages, so that once you start early, by the time you reach a certain age, maybe retirement, you have worked all your body out, and then you need now to retire. That if you started saving, let me start at a young age, by the time you retire, that money would have already compounded. So that's it. Then budgeting, generally just how you're going to allocate funds. So you're going to first streamline all sources of your income, and then you're going to understand the expenses. Expenses are just these things your that are taking out your money, and then you're going to break down into two categories. You can have fixed expenses. By this I mean rent. Rent is a fixed expense. You have loan repayment, you have tuition. Those are fixed expenses. Then you have variable expenses. These are like food, personal expenses, personal personal spending. You have entertainment, but other things you can forego with them. Apart from food, because food is essential for you to stay alive. But entertainment, you can decide not to go to that concert if you have a financial if you have a financial goal or a target. So that takes me to the next step, that is debt. Because most of us, we fall into debt of different categories. Because for example, I studied up to and I completed university, and we invested a lot of millions of money for me to get that bachelor's degree, and I had hope that I would get a very high paying job immediately I complete. But 2 years down the road, I was unable. So all those were in a financial dilemma, whereby I felt so hopeless, and we had gone into debt, because it was a 3 years degree, and then I had completed 1.5 years, and then money got done. So we had to get a bank loan to complete that 1 year and a half. So I had to struggle, look for what to do. And the jobs which are available are very, the jobs are scarce, and the ones that are available are not in line with your profession. Because someone who studied up to and completed university you expect a certain reasonable amount of money. But once you don't get it, the ones that are available, they are giving you very little money. So you either choose to sit home and be broke, or to do what's available as you wait for something better. So what I did, I decided to get something available at the moment as I wait for something better. Because as I'm doing what I'm doing, I'm getting some experience, exposure, I'm networking, I'm learning about the work environment, and that's also an added advantage. So that so I go back to my point of debt. Debt generally, it's like any other trap. Easy enough to get into and hard enough to get out, because you'll need more energy, more resources to get out of debt compared to you entering into debt. Because as you're getting into debt, there are so many considerations that you're supposed to look at, which I will look at in a later stage. Yeah, so as someone who is financially conscious or who is in line with financial intelligence, I'm looking at building a financial emergency fund. And by this, I mean that I'm going to at least save a certain portion. That emergency fund has to have something that can give you an extra push once you face a certain challenge. So I'm going to apply what we call the 50-30-20 rule, whereby 20% is going to go to saving and debt repayment. All debts that I have, whether small, whether these ones on mobile phones, all have to be cleared so that I'm debt free. Then the 30% will go to wants. What do I want? I want to go here, I want to go there, I want to travel. I'll have that 30%. Then 50% goes to necessities. These are things that you can't live without. You can't live without clothes. You can't live without food. Yeah, so that's it. So that I can have a mindful spending, and those small debts that you look at, all those small expenses that you underlook or overlook, they bring about recurring costs. But you have to, if the goal is to save aggressively, then you have to be mindful of the spending. Because as I was talking about debt, that as you're getting into debt, there are things that you have to look at, and these are generally three things: the amount of money that you're getting as debt that you're going to pay back at a later time. Then you're going to look at the interest rate, because the problem that us Africans or people who are not financially intelligent, that your focus may look at the amount you're getting. Maybe you want to offset a problem. Let me say they have chased away or they have sent away your child because of tuition, and then or you have got a let me say any other financial challenge. For you are going to look at, I need, let me say, 1 million to clear off that let me say that problem, and then I'll pay back in a later day without considering the interest rate, because the interest is what someone should first of all worry about. Because if the interest rate is so high, that means you're going to pay more amount. So the third element that you should look at is the due date. And by this I mean that that's when you're supposed to pay back that money to zero balance. Because at in most cases, if you want to build a good credit score, you have to make sure that you pay at least small amounts, so that by the time the due date reaches, that you have at least completed around 90%. By due date, that remaining 10% is easier. But if you haven't cleared anything, by the time it reaches due date and you haven't cleared anything or put something, it is very hard to negotiate with the creditor that I am unable to pay back, yet you haven't put anything. So to get a higher credit score, because you may get this debt, you clear it very well, and then you may want an increment. But if you have want an increment and then you have not deposited any money for repayment, then that is very hard, because we have those cases whereby you need to negotiate with the creditor to adjust on the repayment terms, the interest rate, or at some time to offset the debt whereby you can't clear it because of certain emergencies, maybe the which are unforeseen. This may be like an earthquake struck your business and then it burned down. Thieves came and broke into your business, so you cannot pay back. You need to negotiate with the what? With the debtor to forgive you the debt, and then they write it off. So, as someone who is pursuing financial intelligence, you have to be mindful of the type of credit that you're going into and utilize all low forms of credit, because you don't have to accumulate more debt. Because the more debt that you have, you need more money and more resources to be able to pay and clear it off. As earlier I talked about the emergency fund. So the emergency fund in financial term is just this is just buffer or money set aside to cover unexpected expenses. This can be medical expenses, maybe you have a sudden job loss or urgent home repair. So by this you will need liquidity. So liquidity is money. Liquidity generally is money, which is key to ensure that you have access to this money quickly without penalty. Because if you say you're going to invest this money in a government bond, if you get an emergency, can they give it to you that money immediately there and then? If the answer is no, then that's not the emergency fund. The emergency fund has to be readily available. So there are different investment options, and some of them are stocks or the stock market, whereby you buy and sell shares from publicly trusted companies, where you essentially owning a piece of the company's shares. So you're going to share the profits and the losses. So these are long term investments, 5 years, 10 years, 15 years, and above. So we have bonds. These are government bonds whereby you're going to be loaning the company or corporation or the government, and in return, after a certain period, they're going to pay you interest once the bond matures. So these are viewed as safe investments than stocks, providing a predictable income stream. So from there, the other option we also have mutual funds. So mutual funds, this is like a pool of money from many investors to purchase a diversified portfolio, whereby you're going to have stocks, you're going to have bonds and other securities. So the advantage of this, you're going to once you diversify, you're going to reduce on the risk compared to having one bond. But if you have bonds, you have the index fund, you have stocks, you have the cryptocurrencies. So in case one asset doesn't perform, another will also perform. So this one, you'll be able to, even if you're a seasoned or a long-term investor, you're going to be what? Be able to get something. You because everything can't fail. Yeah, so the other investment option, you also have real estate. Real estate, it has the potential of appreciation, whereby once you have a building, after 5 years, if there are rentals there, they're going to be generating income. And as you know, in today's economy, that land appreciates, and all those anything that you do around land Let me see your constructed house. It's a company. After 5 years, that rent that is being paid will accumulate. So you'll have steady income. So you're going to be generating passive income. Though there are expenses such as maintenance costs, taxes, insurance, and repair, etc. But this is passive income. Once you have it, you're going to generate money or passively. The costs will be just maintenance, taxes, insurance, but you'll have a steady income. So by this, you need to choose the right property, whereby it is strategically located in a place that has potential for growth. It surrounds good schools, these universities. So if you strategically build around a university and you build hostels around that university, the university can also partner with you and be like, we need safe space for our children, so your building is good. Can we lease it? And then you get some money. You can get that contract 3 years, 3 years, 4 years. You keep renewing, keep renewing, keep renewing. You have very good services. Who will compete you? You'll be generating money passively. So thank you and have a good day.